Hello, everybody. Morning. So, welcome to the Environment Committee informational hearing forum, whatever, called Ensuring Connecticut's Resiliency. This is invitation only. Do I have an echo?
I think it's the mic. Oh.
Yeah. Okay. And just want to welcome everyone who's coming. Invited guests will come in to speak this afternoon. This is not a traditional, it's not session yet, as you guys are aware. It's not a traditional hearing, so we're not going to follow all the exact rules of a normal hearing. We are going to shoot for brevity and efficiency because there's time. I think people need to make it to places later today. So on that note, I'll cut it off quickly, but just understand I expect most presentations should be shooting for about 5 minutes, and questions from members should probably only last no more than 5 minutes as well. I don't want to have to cut anyone off, but just bear in mind that we're trying to move very quickly today. Are there any remarks from my co-chair? You're good. Ranking members?
I'm good.
Thanks, Pat. Has there been a Harding sighting yet? We'll hear what he has to say when he gets on. So without further ado, the first speaker we have, George Bradner, Assistant Deputy Commissioner, Connecticut Insurance Department. Thank you for coming, sir. Oh, you're presenting a report. We can give you a little bit of latitude.
Can you see it?
And for the record, a legislative 5 minutes is 15 minutes.
Say that.
Go. Get the. I think I'm ready. I'll try to cut it down. All right. Thank you, Senator Lopes and Representative Parker and distinguished members of the Insurance or the Environmental Committee. Hopefully they're all online. This presentation outlines the blueprint for resiliency featuring automatic actionable recommendations for CID, Connecticut Insurance Department Severe Weather Mitigation and Resiliency Advisory Council. Connecticut faces increasing threats from severe wind, flood events due to climate change, causing significant financial burdens for residents. The goal is to move the state forward in a culture of resiliency that reduces disaster recovery cost, keeps families in their homes, and stabilizes the insurance market. This committee was convened in October 2024 by Commissioner Mays. It had an expert group of representatives, a broad cross-section of stakeholders, including insurance industry, regulators, academia, finance. Council members hosted 2 public hearings featuring nationwide experts to identify best practices from successful programs around the country, like Alabama and Florida. There are 13 states that are looking into a program, and actually 7 have already enacted through legislation a program. Maine is one of the only states in the Northeast. This work culminated in our report, June 30th, 2025. Leadership of the council was by Sonia Larkinthorne, consumer advocate, and Robert Hoetling, state infrastructure advisor. Collaborators were members from the Hartford and Travelers and Swiss Re, academic experts from UConn, Circa, nonprofits like the American Red Cross and the Connecticut Green Bank. Let me just sort of catch up to myself here. Sorry. Key recommendations, the council prioritized immediate support for existing programs that do not require new legislation to bypass the wait for large-scale legislative funding. Strengthen proven initiatives to swiftly provide support for homeowners' structural integrity and resilience. Support partners, we're looking at the Connecticut Housing, and Connecticut Homes. Energize CT enhances the focus of resilient buildings and practices within the existing energy and efficiency initiatives. Habitat for Humanity, which operates several very successful programs throughout the state of Connecticut, and the Connecticut Green Bank Smarty Loan. Leverage those loans to finance a wide range of upgrades for storm damage. Fortified mitigation pilot launch. We're looking at launching a small scale pilot program focused on reinforcing roofs to the IBHS fortified standard. It's targeted at high risk areas. The pilot will demonstrate how these standards reduce wind and rain damage, building this case for a statewide rollout. We seek private and philanthropic contributions from organizations like Home Depot or industry partners to begin this work before the legislation appropriations are available. Awareness, implementation of robust communication campaign to help residents understand their specific risks of flood and wind and how to reduce them. Ensure outreach reaches diverse demographics, including lower income and older populations who may not be as digitally literate. Also include legislators and government officials, homeowners, small businesses, contractors and builders, evaluators, municipal and local officials. Develop a user-friendly, multilingual website. It will be central to our program. And Consumer Information Center to easily understand info and information, interactive tools for all insurance types, especially flood insurance, was one of the first upgrades we've made to our website at the insurance department. We've also embarked on a relationship with First Street to allow residents to access their property locations to see what their flood risk is. As we know, this FEMA flood maps are static and are not updated as frequently. Funding sources, we're looking at potentially, if we were to do a program, legislation to provide state income tax credits for expenditures of proven wind and flood mitigation measures. I think one of the key things that will be helpful to residents in Connecticut is a catastrophe savings account that proposes broadening eligibility for these accounts so that any homeowner can save pre-tax dollars for disaster repairs or mitigation upgrades. And from a long-term strategy, consider using a portion of the surplus lines premium tax to revenue over 10 years to sustain the grant administration. Equity in focus here is prioritize funding for low and moderate income households at or below 80% of the average median income, and direct at least 40% of grant funds to the most vulnerable residents in the high-risk communities to ensure equitable protection across the state. Training needs, invest training for evaluators and contractors to ensure resiliency upgrades meet technical standards. Since Connecticut currently has limited IBH certified contractors, this initiative will develop a local workforce needed to handle 800 to 1,000 home fortifications per year. This has created a ripple effect in other states where household mitigation reduces disaster recovery costs, protects public safety, and keeps people in their homes. It also creates market stability. These actions contribute to a more affordable and competitive property insurance market over time by reducing avoidable losses. And finally, the proof is in the pudding. We all know the statistic from FEMA that for every dollar spent, you save $11 in resiliency. But after Hurricane Sally down in Alabama, the University of Alabama conducted a study. The data from storms shows that homes with fortified designations saw substantial performance improvements compared to conventional homes. Claim frequency was reduced by 55 to 74%. Claim severity was reduced by 14 to 40%. Loss ratio reduced by 51 to 72%. Substantial financial savings. The study estimated that if all conventional homes in the affected areas had been retrofitted with the fortified roof standard, insurers would have saved 67% in losses, and policyholders would have saved $32.6 million in deductibles that they had to pay. If all houses had been built to fortified gold standard, insurer losses would have been 75% lower. The power of the designation shows that finding that homes with an official fortified roof designation performed 50% better than homes built to similar local code. Without the third-party verification process. This underscores the value of independent fortified evaluator in ensuring construction integrity. In closing, by adopting these science-backed standards, Connecticut can move from theoretical benefits to proven financial and structural protection from these programs. And will also help availability and affordability of homeowners insurance within the state of Connecticut continues. Thank you.
Thank you. That was incredibly concise. Any questions from members of the committee? Floating around.
I can ask something, but you go first.
Sure. I had a couple questions. From what the statistics you just gave, it seems like insurance companies in general would, the industry would see a benefit from having houses rated at higher levels of resiliency. Should there be incentives from the industry? Should there be incentives from government? What's your take on what we can do in our role to encourage homeowners to go after these things, which are not inexpensive to do, but could see long-term benefits for both the homeowner, the industry, society in general?
Yeah. I think both the government and the industry, we all need to work together on this issue. We have looked at our filings that we've had at the department, and we do have 13 companies that do currently offer a fortified credit ranging between 5 and 20%. We'd like to, we're actually working very closely with the National Association of Insurance Commissioners, the Center of Excellence there, to look at what would a reasonable credit look like in the Northeast. The issue we have here versus the South, the Gulf Coast is, the Gulf Coast has a high frequency of storms and a high severity. We have a low frequency, but a high severity. So a credit in Alabama will look a lot different than a credit in the Northeast. But we still think the credit and the numbers that you see here would transfer to the Northeast. I think we also look at, right now, we see homeowner rates continuing to go up. We all own homes, and we've seen our rates increasing. To me, by doing these things, we start to flatten that curve because we start having, claims, the size of the claims gets lower, and what companies are paying out is less. So that will help the size of rate increases that consumers are seeing. It will also help with availability and affordability of homeowners insurance. So I think we'd like to see, more credits. And one of the things that we're working on from a communication and education perspective, though, is we want to bring more contractors in the state. So we're working with an organization called Flash and Safe Homes America, and to train contractors in Connecticut. Right now, there's about 7 contractors that have already been certified. We'd like to get some more contractors certified. We're in the process of working on a grant, partnering with a grant with the Connecticut Green Bank to do a small pilot in Connecticut. And, so we need evaluators so that they can go out and evaluate what the property needs for a fortified roof, and then make sure that it's done to the standards that meet the fortified standards. So we're working very closely and diligently on that front. Ultimately, we'd like to move forward with legislation that we can bring more people in. The thing that's important in Alabama, they've only really funded through a grant program 10,000 homes over the past 10, 15 years. But over 50,000 homes are now fortified, have a fortified roof or a fortified gold standard. So it's created its own opportunities. People see the value and they're like, I want that. And so we need to create that same synergy here in Connecticut.
Okay. On that take too, and I understand insurance is the socialization of risk, but there are industries out in this world that contribute more to climate change than others. Did the industry feel, or the agency feel that they bear a larger burden and should maybe be part of the solution of paying for resiliency? And one of the ideas we've been thinking about, and I think we started it last year and we may proceed with it this year, is to put a fee on policies for companies that are large emitters and creators of climate change that'll go into a resiliency fund that would pay for some of these improvements.
Well, I'd like to work together with all parties to move this forward. I think the industry is doing a lot of work in this space. When you look at, I mentioned the IBHS. The IBHS is an industry-funded organization, and they've done a tremendous amount of study into how to fortify and protect property from loss. They have a facility down in South Carolina where they can generate a Category 3 hurricane. So they're doing some major testing on what has to happen in order to protect the structure of a property. They're also doing a lot of work in the wildfire space because of what we've seen out west. So, I think the industry is doing a lot. I think we can all do more, and I'd like to see us all work together to, resolve, this problem. And, I think that's the best we can do.
Yeah, I mean, I struggle with it too. It's whether or not I feel government's role should be finding a way to fund some of these resiliency projects, and if we do, should we be imposing fees on insurance policies? On should we have a role in that to help fund some of these resiliency projects? I think we know how to do the resiliency in a lot of levels, but how to pay for it could be a little bit more complicated.
Yes.
Sure.
Representative Parker.
Just thank you for your time and what you shared. Are there any insights we can get from the homes that end up having these fortified roofs or meeting these standards? Is it about construction date or time frame? Is it about income for the owner? Is it certain kinds of communities? I mean, what are the trends that we see based on who's taking advantage of these?
Well, in the Northeast, we have old building stock. So, down south and in many areas, they're building new homes much, we have maybe, well, how many, 3,000, 4,000 homes a year built in Connecticut. You see that in a month in some areas down in the south. And in Florida, so their building codes are, very aggressive. But again, making sure that, the homes are built to those building standards is always, the validation is always critical. That's why having evaluators ensuring that that's happening. The cost for a fortified roof, and when we look at, Connecticut, as I said, we have old building stocks. So we need to look at the first major repair that a person's going to make on their home is their roof in many instances. And that's the most vulnerable part of your home. Over 50% of losses usually start with the roof over your head. So if we can start building that culture and getting people to understand what is a fortified roof, and doing a fortified roof is not adding, thousands and thousands of dollars of additional expense to your roof. I just did a fortified roof on my house 2 years ago, and the roof, it cost me about $12,000. Doing the fortified element of it was about $1,000 in exponential, amount. So it's not a lot of additional expense. If we create a grant program, we can help people in that process. What we looked at, and when you look at our report, we looked at providing up to $10,000 for people to be eligible to replace their roof. And if it costs more than that, they would be picking up that excess over the 10,000. But this would incentivize people to move forward and, fortify the roof and get the evaluator in to make sure it's done correctly, so we can ultimately begin creating that resiliency within our communities.
Thanks.
Representative Callahan.
Thanks, Senator Lopes, and thank you for coming in. I was listening intently, but I'm trying to hear what suggestions you would have, and for incentivizing people to do something like fortified roofs. What did you have suggestions of where that money should come from?
Yeah, well, when we looked at it, one of the suggestions in our report is possibly looking at these excess surplus lines premium tax that the department collects, and using those funds in order to, move forward with a program in the state of Connecticut.
Okay, it's as we mentioned, insurance is getting so expensive. It's one of the it's mortgage, insurance, and electric bills are biggest expenses for most people in Connecticut. And we're already paying a lot of public benefits that fund the Green Bank and other incentive programs. I just don't know how much people can take. And And I think we should be building better and building stronger. And there's a lot of different factors that come into play. Thankfully, we had a quiet hurricane season, and right down the road is Mark Twain's house, and he said, if you don't like the weather, wait 5 minutes. So that's New England for you. But finding just making people's insurance more expensive, making their electric bills more expensive, I have a problem with, but hopefully we can find the money. I completely disagree with the fact that we're going to start assigning blame to the same people that are going to heat our homes in the coldest weather we have coming up, and that most of Connecticut is powered by natural gas, and we're going to start penalizing people for providing that comfort and safety and security to the people of Connecticut. So looking at creative ways to get people to incentivize people to improve their homes is great. I just had to put a new oil tank in my house. By doing that, I prevented an insurance claim, prevented an environmental spill. These are things we have to do as homeowners all the time, and I certainly think we should be having incentives for things like that. The old traditional oil tanks that are either in the ground or in your basement they start to rot out because of all the additives in the fuel. But that we should, I guess we're going to look at incentives for all these things to prevent all kinds of environmental disasters. So, but assigning blame to the people that provide the comfort to the people of Connecticut is going to be a very difficult ask. But I appreciate you coming in.
Thank you very much. Wait around, a day, and it's going to be minus 13. So, and then we're going to have over a foot of snow. So,
Yeah, perfect timing in some ways. Any questions? Seeing none. Thank you very much for your time.
Thank you.
It's
Thank you.
appreciated. Next speaker is Amy Chester, Director, Rebuild by Design.
Good morning.
Morning.
See if I can get taller. Nope. Okay. Great. Hello, my name's Amy Chester, and I am the Director of Rebuild by Design. Rebuild by Design was started after Hurricane Sandy, and we've been working in Connecticut ever since. We started out as a federal design competition that awarded $10 million to Bridgeport, Connecticut. And we've since been working all around the country and the world and been doing a lot of research to show that climate change is here, that our communities are suffering, and that it's our job collectively to do something about it. This is our Atlas of Accountability, and the darker areas represent the areas that have had the most disasters for a weather event between 2011 and 2024. I'll just show you an aside that on the left-hand side where you see a lot of the white area, which looks like it has less disasters, those are areas that have had high heat deaths. But our federal government doesn't give disaster declarations for heat. They only give it for economic damages, such as flood. And what we learned is that 95.5% of US counties have experienced a disaster declaration during that time. And you can actually poke around on our website and it will pop up with all the information about it, county by county. And what we learned about Connecticut and recently released was that Connecticut has had 11 federally declared disasters during that time, which has cost taxpayers over $500 million. I know it's easy. I used to work for the legislature too. It's easy to say, okay, well, that's federal money or that's private money or whatever it might be. But it's all of our money. We are all contributing to these costs. New Haven County has had the highest, and Fairfield and Litchfield have had 9 disasters each. Disasters are impacting our economy, communities are suffering, and again, it's happening on our watch. And this is what it looks like. In Connecticut, 61% of the areas are vulnerable to flooding. Connecticut might see 20 inches of additional sea level rise and 24,000 acres of land lost. And that's on top of the 16 Superfund sites, which are around Connecticut, which, as you probably can imagine, when it floods, all of the contamination gets lifted up and taken into our schoolyards, our playgrounds, and our basements. And already in 2023 was the 4th year where crop damages have been exceeding thousands of acres. And this is what it looks like if you zoom in. On the left-hand side, you'll see the disaster occurrences and the locations of which who have had the worst. And obviously, you can see that every place in Connecticut has had disasters. On the right-hand side, you can see where the federal dollars are going. On the left-hand side is the social vulnerability index. So these are the people that will fare the worst during a disaster. And on the right-hand side, the energy reliability index. And some stats just about the people who are the most vulnerable. The financial burdens are not equal during a disaster. The people who are lowest income have the highest burden, and they usually have the highest recovery time and do not recover equal to people of different wealth. We've also published all of the data. So this is what the data table shows you, and I'm just going to zoom into it so you can see. On the top, you'll see the different storms, and right next to it is just FEMA's number. And then you'll see all the counties, how much dollars each county has had. It's all on our website. And you can also see which of your districts have had the worst disasters. So you can go across the aisle, you can keep to your aisle, and you can say, hey, let's get all the dark people together, let's get all the dark districts together, and let's figure out a solution. So we have we're calling for 4 things. The first is shifting post-disaster dollars to pre-disaster. We get lots of dollars after communities have suffered. It's backwards. The second is creating new sources of dedicated funding, and that is something the state can do. And that's something that we're talking about today. And it's incredibly important that there are new reliable sources. The third is mandating that US insurance companies take into account mitigation. So if you do fortified homes, and I'd like to add that fortified homes do not help in a flood at all, it's only roofs. So it's actually not a comprehensive answer. But even if you were to do that as a partial answer, you can mandate that insurance companies have to lower your rates. If you are in a FEMA flood zone and you have FEMA flood insurance, if you take community-wide action through their community rating system, everybody's rates go down, but that doesn't happen in other places. And lastly is creating better infrastructure, making sure that every dollar that the state spends is doing it in a way that's going to fortify for the next generations, is doing it in a way that can hold rainwater and stormwater, and do it in ways that enhance livability. I just wanted to show that there's a bunch of different conversations that are happening around the US, looking at what we can do, working with insurances and insurance surcharge. Happy to take any questions.
No problem. Thank you. That was very fast.
You said I had 5 minutes. How did I do?
Easily within. Elaborate on, the one thing you said that struck true, and I've always thought about for a long time, is we spend hundreds of $millions and billions of dollars after a climate disaster. And, spending some of that money beforehand to mitigate it sounds like such logical sense. Elaborate on that a little bit more, and like how we could do that.
How many people were here during Hurricane Sandy? Is that something that has stayed with you? Have you thought about it year after year when you start seeing that the temperature is rising in the sea and the communities are knowing that there's going to be a potential hurricane? You have that muscle memory once you've been through it before. And I'll tell you, one of my best friends from high school lost her home in Staten Island during Hurricane Sandy. There were fishes swimming in my mother's basement. My aunt and uncle and their parents lost 2 cars in Rockaway. And I'm from New York, if maybe you could figure that out. It's something that we're all terrified of going through again. And there's no reason that we have to go through this. We have all the answers. We just have to decide that we want to implement them.
So you believe that we can do enough resiliency to protect against a storm like Superstorm Sandy?
Yes, sorry if that wasn't clear. Yes, absolutely. There's so much we can do, and there's a lot of what's happening throughout the country. So for instance, we work with New York State to create a $4.2 billion fund for flood resilience. And that has been, it was voted in 2022 by the voters, and the state has already allocated $1.1 billion. So if we start now, if we start saying, okay, there are different sources. For instance, we also modeled a 2% surcharge on certain types of property and casualty insurance. And we worked with a bank to do this work and found that Connecticut could raise about $3.8 billion in 10 years. So there are many different ways that we could raise those dollars, and we can dedicate those dollars for the people of the highest physically and social vulnerability. And the state can do that work. And we would love to work with you on that.
Representative Parker?
Thank you, Senator. Thanks for your presentation. When you talk about creating better infrastructure, what are your top priorities in terms of how we could hit that point?
Our number one priority is to figure out how to do it as a way that enhances our communities every day. So I'll give you an example of Hoboken. And Hoboken was also one of the winners for the Hurricane Sandy competition. Hoboken is on the Hudson River, but it used to be an island. So the back of Hoboken floods. Hoboken's in New Jersey. It's about a mile by a mile. And yes, the government is looking at the river flooding, and that's from storm surge. But it's actually the biggest flooding is coming from rain events. Hoboken has taken over property that was underutilized or even brownfields and has turned it into 5 resilient parks. So now this urban area has 5 new parks inside Hoboken that all capture the rain and hold it. One park called Resilient City Park holds 2 million gallons of stormwater, 1 million gallon on top, and that's using different types of retention, like a basketball court to hold and green infrastructure, and then 1 million gallons underneath the park. And that area underneath the park is reserved for 20 blocks. So that park pumps water underneath the park from 20 blocks around that used to flood and holds it until the sewer can catch up.
So it's not like you would say it's roads across the board or it's park. It sounds like it's hyper specific and localized.
No, I think that there's a lot of things. So one of the things we have to do is figure out, are we going to retreat from any areas or are we staying everywhere? Because those are basically our options. Do we fortify or do we retreat? And then if you're going to fortify, you have to think about, okay, what do we have to raise? So I'll give you another example from the Hurricane Sandy competition in East River Park in New York City. It's a 57-acre park that abuts thousands of public housing units. And that park has now been raised 8 to 10 feet. So that entire park has become a barrier between the East River and the community. So it could be raising roads, it could be raising homes, it could be creating parks. There are many different ways to go about it, but the kind of the dedication of figuring it out has to be localized.
Thank you. Thanks.
Representative Callahan.
Thanks, Senator Lopes, and I'll try and limit my comments and be brief, but I appreciate you coming in, ma'am. Are you so New York raised all this money? How did they raise the money for the resiliency, the over $1 billion?
So it was $1 billion between New York, New Jersey, and Connecticut.
Okay, I missed that. Okay,
and that was given from HUD after the Hurricane Sandy work. And then since then, dollars have been allocated to the same projects like in Connecticut and have used a mix of federal funds and state funds.
Okay, and one of the suggestions I heard you mention was perhaps a 2% surcharge on insurance. That would be, so I live in an upland area in the Northwest Hills here. I could be possibly, and correct me if I'm wrong, charged extra to pay for some disaster mitigation for people, excuse me, people who chose to purchase or build a house in a low-lying shoreline area.
Well, yes. However, you might also flood from rainwater. We're seeing increased rain all around the country.
Not a chance. I've already have resilience in place and been here 30 years with pump systems and backups. And I'm on ledge, so I had to do it. So okay, I was just so it's a program to tax all to pay for some.
It's a program to make sure that all of us as taxpayers who are paying for this aren't paying for this and communities aren't suffering.
Thank you.
Just follow-ups. In Connecticut, last couple of years, we've had huge problems with especially sewer overflows during storms. As you know, our sewer lines and our storm sewers are combined, ancient. My hometown is nothing but problems about this. Any ideas on like how are other places fixing up these problems?
Absolutely. There are combined sewer overflow problems in many, many different places, including in New York City, including in Hoboken. And Hoboken was actually required to do that, to the upgrades that they did, because they were doing because what happened was okay, so sewers operate perfectly fine when there's not a lot of rain. With increased rain and the intensity of rain and how fast it flows, the water gets backed up and has to go somewhere until the sewer can catch up. So it's not that the sewer doesn't work, it's just that it's not built for the amount of rain that we have. And for years, the EPA and the state's environmental protection laws would make sure that in areas that CSOs would pollute our waterways, that those waterways would not be polluted. So we have many, many decades of experience thinking about how to keep that water out of our waterways. What's happening now is that it's happening in areas that are not near necessarily our waterways. So it's not about polluting our waterways, it's about polluting our homes. It's about coming into our basements. So all different types of measures that will stop and hold the water before it gets there into the sewer, it is, answers. It's all part of piece of a puzzle. So I'll give you examples. You could have a green roof. You could have a cistern that collects all the water in your property, and then you can use it again to wash your car or to water the plants. You can use certain types of planting in your garden that contributes and holds more water. Then on the street, you could have green infrastructure on the street. You could raise the street a couple of inches and use the street as a way of a holding tank above. You could have a holding tank below the street, and you can keep going, on and on and on. Every single parking lot could have asphalt that can hold more water. Parking lots can also have what's called like a basin underneath. Same idea as the park in Hoboken. It can hold that water underneath. So the engineering solutions are here. We have to catch up as society to say, okay, we're going to take care of this problem.
That is an enormous problem. We have a situation in a neighborhood in New Britain. It's 8-inch pipes that are 100 years old, cannot handle any storm. And before, the storms weren't as often, weren't as heavy, and it was bad, but now it's out of control. It's every heavy rainstorm, 30, 40 houses flood, their basements flood out. And I've not heard one time the idea of building a place to catch the water until the storm system. We just keep being told we have to go from an 8-inch pipe to a 16-inch pipe, and it's going to be $16 million.
And decades. Like,
Yeah.
think about how long that would take.
It's taken decades.
It would take
to get there.
decades in order to do that. So there's definitely things that you can do that are much, much quicker that will help on a regular storm. For the Hurricane Sandys, for the Hurricane Idas, for the bigger ones, you might have to also use bigger infrastructure under the ground.
Yeah, I mean, it's more common. It's not a once or twice a year. It's a once a month situation. We're dealing with an issue now where Massachusetts, on every rainstorm, they dump their sewer get dumped into the Connecticut River, which
Right.
then immediately flows in
Yep.
Connecticut. It's not really a problem for Massachusetts, but it's a problem we have to deal with every time. So every heavy rainstorm in Massachusetts ends up with unswimmable water in the Connecticut
Absolutely.
Riverway in Connecticut.
Just in the last 2 months, 2 people died from heavy rain in New York City. One person was in a building and they were operating the boiler and making sure that everything was not flooded, and then he got flooded in. And then the second person went in to get his dog. And that was both, one's in Manhattan, in Upper Manhattan, and one is in Brooklyn. And we don't have to die because of rain.
Any questions? Seeing none, thank you very much for your
Thank you.
testimony. Next up, for brevity, we're going to do 4 of the presenters at once as part of a panel, but we'll give them all their time. Eric George, Insurance Association of Connecticut, Sean McLaughlin, National Association of Mutual Insurance Companies, Ethan Alman, Environmental Issues, Resiliency, American Property and Casualty, and Peter Myers from CBIA, whatever CBIA stands for.
Senator,
Connecticut Business and Industry Association.
when I worked at CBIA, others had a different acronym, or the same acronym, but different words.
Different
Or to
words?
say it right now.
Well,
Um,
Pete's a nice guy.
Pete's a very good guy. So thank you, Senator Lopes, Representative Parker, members of the Environment Committee. I'm Eric George, the president of the Insurance Association of Connecticut. I'm joined by Ethan Almond from the American Property and Casualty Insurance Association, Sean McLaughlin from NAMIC, the mutual insurers, and Pete Myers, who you've already talked of. I am going to hand it off to Ethan, who's going to start us off, and then Sean. I will then say a few words, and then Pete.
So good morning, chairs, ranking members, and members of the Environment Committee. Thank you for the opportunity to be here today. My name is Ethan Amman. I'm a senior director with the American Property Casualty Insurance Association, or APCIA. And our organization represents over 1,200 insurance companies and reinsurers that collectively serve millions of policyholders across the country, including here in Connecticut. So APCIA members provide coverage to families and businesses throughout the state, helping them recover after disasters and manage everyday risks. So I had prepared about a 10-minute statement, but I'm going to do the very skinny version here if I can. So my core message is this: Connecticut's property insurance companies and insurance markets the companies are actively advancing resilience, risk mitigation, and climate-driven climate resilience to protect consumers in a stable, competitive insurance market. We recognize that Connecticut, like the rest of the nation, is experiencing more extreme weather and evolving environmental challenges. And insurers are on the front lines of climate impacts, paying claims after disasters strike, but also on the forefront of solutions, working to prevent and mitigate losses before they occur. So I wanted to just very briefly describe the big picture of insurance markets and trends affecting the industry. So the landscape is experiencing several converging factors. On the one hand, we're seeing insured losses from natural catastrophes climbing. Global insured natural disasters have roughly doubled over the past decade. And thankfully, Connecticut has avoided the worst case of these mega disasters, but the state is not immune from future catastrophes. At the same time, we're seeing record high inflation, and that's in particular for construction costs, both labor and materials. So we're also seeing legal system challenges across the country, and demographic trends and land use patterns are also putting more people and property in harm's way. So in essence, the factors that are affecting insurance losses go well beyond climate change. We're talking about where and how we build, the cost of rebuilding, the frequency of severe storms, and then the broader legal and regulatory environment. The good news is that Connecticut's insurance market remains strong and competitive, with over 140 insurance companies writing homeowners policies here in the state. And Connecticut also benefits from a robust private market with many carriers participating and regulators here that have been proactive in monitoring market health. So while insurance is broadly available, we all know that the cost of providing that coverage is rising, but by reducing the underlying risks, we believe we can help temper these cost pressures over the long run. So despite those challenges I've described, I wanted to stress that insurers are among the strongest advocates for risk mitigation and resilience. And I'm just going to highlight a few of the ways that insurers are advancing that resilience, and many in partnership with governments and consumers. So insurers today use incredibly sophisticated catastrophe models and climate analytics to understand evolving risks. Insurers have also long supported actions that can reduce the likelihood and extent of losses. So insurance companies are increasingly pivoting from a reactive repair and replace model to more of a predict and prevent stance. And that's through the use of technologies and smart sensors, such as auto shutoff systems, electrical fire prevention tools, and high-resolution imagery. The insurance industry has long championed strong building codes as the most effective form of mitigation. And a presenter earlier mentioned the Insurance Institute for Business and Home Safety, or IBHS, which is really conducting full-scale research into analyzing the construction methods that are most effective at protecting against various perils. Also, throughout the country, insurers regularly collaborate with state agencies on emergency preparedness and mitigation. And insurers also advocate for financial incentives to help homeowners and businesses implement the mitigation that we advocate for. And this can be accomplished through the use of grants, low interest loans, waiving or reducing fees and tax credits. And also another important point to mention is that mitigated properties also often have higher resale values, so a benefit to the homeowner, and they can mean lower costs that insured homeowners pay in terms of deductible costs and frequency of disasters that they experience. Lastly, I'll just mention that insurers recognize that policyholders are also a key player in the resilience equation. And so the industry has ramped up efforts to educate consumers on how to harden their homes and businesses and to be aware of the risks so they can take the steps that they need to reduce those risks. I'll be submitting a written statement that kind of will dive into some more of these issues in more depth with Connecticut specific examples. I want to briefly just touch on some specific actions that insurance companies are taking with respect to climate change. So, as I mentioned, across the industry, companies are using advanced modeling and advanced analytics to better understand climate and predict its impacts in the future. Over 80% of the property casualty insurance market countrywide, and that includes insurance companies operating here in Connecticut, also participate in the National Association of Insurance Commissioners annual climate risk disclosure survey. I believe my fellow panelists will discuss more about insurers' climate reporting and regulatory disclosures. In parallel, insurers are also reducing their own carbon footprints and supporting the transition to a lower carbon economy by ensuring and investing in renewable and green technologies, green buildings, clean transportation, and other strategies to increase climate resilience and long-term sustainability. I'll just briefly mention the proposal raised previously before this committee, the 5% surcharge on insurance premiums for fossil fuel companies. APCIA opposed that measure, as did other trade groups. And we have several core reasons that'll be described in the written statement I provide. And I believe my fellow panelists will also address many of those specific concerns. But APCIA remains opposed to any surcharge on insurance premiums for fossil fuel related companies. And we urge the committee, as you evaluate climate solutions, to focus on collaborative risk reducing strategies and not narrowly targeted punitive measures with many unintended consequences. So in closing, thank you for your leadership in bringing the insurance industry to the table for these critical climate and resilience discussions. Our core message today is just one of partnership and proactive risk management. We're here to help Connecticut adapt and stay resilient. So thank you very much for your time and attention, and I will pass on to my fellow panelists.
Question, if you don't mind. I mean, you're talking about the collaboration. I agree with it too, and the tools you're mentioning the industry has in terms of data collection and more of these high-end things. Would you be willing to share that data with the state so we could better target resiliency projects?
Yeah, so the insurance industry regularly submits a lot of information through the National Association of Insurance Commissioners, NAIC. There's also some sensitivity around releasing specific proprietary data of insurance companies. But the industry has also partnered in terms of sharing modeling and their best research with emergency management agencies and first responders and other entities that are responsible for disaster mitigation and recovery.
Thank you, Ethan. And I'll speak a little bit to the disclosure in a moment, Senator Lopes, but Sean.
Yeah, thanks, Eric. Senator Lopes, Representative Parker, members of the committee. My name is Sean McLaughlin, and I'm the Regional Vice President of State Affairs for the National Association of Mutual Insurance Companies, or NAMIC, here in the Northeast. Since this is my first time testifying before this committee, let me briefly say a few things about NAMIC. NAMIC is the foremost trade association representing the property casualty insurance industry, serving more than 1,300 member companies, including local and regional insurers, as well as some of the nation's largest carriers. NAMIC members collectively write $467 billion in annual premiums, representing 61% of the homeowners and 53% of the automobile insurance markets. For more than 130 years, NAMIC has been the leading voice advancing public policy solutions and regulatory frameworks that promote a strong competitive market and protect our members and their policyholders. And we appreciate the chance to be here today. I want to go back to the previous testimony because I am actually from Hoboken, which got a lot of airtime. And Not only does that park do exactly what was mentioned, but it also has a great Italian deli at the high point. And it's called Alessio's and it's excellent. So if you have a chance to go to Hoboken, there's plenty of good Italian delis, but I do recommend checking out that park and Alessio's. Anyway, to business. So talking about surcharges, I think I want to just start by being clear about what surcharges are in an insurance context. Surcharges are fees from government passed through the insurer to finance a particular fund or project, typically, like the Connecticut Crumbling Foundation surcharge, for example. They're levied on the consumer who is purchasing the policy, right? They're not levied on the insurer. It is also crucial to mention that surcharges should not really be part of the premium tax calculation. Surcharges are typically broken out on a customer's bill to show the surcharge cost in addition to the premium cost. So it's clear to the customer what is and what is not premium and to avoid the masking of fees, right? A surcharge is not underwriting. It can't, and it cannot be actuarially justified under rate standards. So underwriting is the process of assessing, selecting, and classifying risks so that each customer is matched with an appropriate policy and premium based on expected frequency and severity of loss. It's supported by actuarial science. Connecticut requires that insurance rates are not, quote, inadequate, excessive, or unfairly discriminatory, and I'll add that rate making must be grounded in objective data statistically correlated with losses. And a surcharge is not an assessment of that industry's expected loss cost or exposure characteristics. It's imposed solely by the government because of who the policy is and what line of business the policyholder is and what line of business it operates in, which is a public policy judgment, not a risk classification. What I'm saying is really the cost of a surcharge is not reflective of the risk that an insurance company would calculate when underwriting. It's an additional subjective cost. Insurance is based on matching rate to risk. The fairness of insurance depends on that fact. That's how premiums are calculated, and surcharges are outside of that calculation entirely. They're an additional cost to consumers that is not reflective of their risk, and they're counterintuitive in that way to the basis of insurance. We're also concerned about the insurance industry being used as a punitive tool towards another unrelated industry. I'll emphasize that risk-based pricing benefits consumers when factors are chosen because they improve the accuracy of predicting loss, not because they advance non-insurance policy goals. Using rates to redistribute costs or punish lawful activities undermines that framework and moves towards one price fits all, which is neither scientifically sound nor fair. The proposed surcharge is an attempt to change behaviors towards fossil fuel usage, and I understand that, but it is not directly related to the business of insurance, and therefore we do not believe the insurance industry should be used as a cudgel to punish a separate industry. Thank you for your time. I look forward to the questions you may have.
Thank you, Sean. So many of, go ahead. Oh,
Yeah,
sorry, Senator.
just a quick question. You fired it out so quickly. I started liking you when you started talking about delis, but
Is that where it ended?
after that, it then went south there. I mean, there's a certain, I've been struggling with this is a certain issue that we have insurance. You don't want to be used as a cudgel against other industries, but the reality is there are industries that, we have climate change that is causing risk to go up. So rates are increasing and policies are being canceled based on climate risk. And then there are companies that are contributing far more than others to that risk and climate change in general. And you're insuring those companies. And in fact, beyond that, on a finance level, I mean, we have an insurance industry in Connecticut that's quite large. They're investing $1 billion of their money into these companies, and from the straight investment side too. I mean, there has to be a certain amount of thought that we are insuring and investing in companies that are causing the problems that are causing policies to go up and causing policies to be canceled. And we're trying to get our arms around it. And I'm not saying I have a solution to this, but from the industry side, what do you think the solution on this problem is?
Yeah, so certainly, I mean, and I should have mentioned, and I believe my colleague from APCIA did. I mean, we're certainly supportive of the industry's invested in and supportive of mitigation, fortification, resiliency efforts. That is something that is a priority of the industry, and we think that that's something that we want to work together with government to achieve. In terms of the surcharge and understanding the relationship right between fossil fuel industries and climate change and insurance that you outlined, fossil fuel companies need to be insured, right? I mean, They simply do. That's the reality of the situation. The investment issue that's a solvency question as well. And I think, that's not why we're here necessarily, but, there is a freedom to invest. I believe, I think that is crucial to the insurance industry. And we're trying in the fact that we are regulated for solvency like banks are, that we have to be able to cover every policy that we put out and that we write. I think preparing and fortifying and mitigation is a place where we believe that there's a lot of progress to be made, and something that we would certainly be supportive of and want a partnership with government on.
Any questions? Yes, Representative Baumgartner.
Thank you, Mr. Chair. And just on that wavelength, you talked about mitigation investments, so floodproofing, green infrastructure, et cetera. Is that reflected in your members' underwriting decisions?
Yeah, so typically, and all of our members are different, right? So I don't want to speak for any specific member, but yes, certainly, if your house is fortified, right, that will put downward pressure on your rates, because the risk is less. It's as simple as that. Insurance is all about matching rate to risk. There's nothing else involved, really. It's purely about, what the risk is, and that's scientifically based. That's what your rate is going to be. Fortification mitigation efforts will put downward pressure on rates. There's no doubt about it.
And in many cases, this fortification is done on the behalf of the government itself, right? And those benefits are then passed on to the surrounding community. Case in point, the example the chair used in his community in New Britain with the 100-year plus pipes, right? That impacts 30 to 40 homeowners in that community. So should those improvements be made, resilience improvements be made, that obviously would result in a lower likelihood of a catastrophic event with those pipes. And so in that case, there should be a savings associated with the insurance policy when it comes to underwriting it. So that was sort of my question. And how are those investments sort of reflected and taken into account by the insurance industry when they're making these key underwriting decisions?
So I'm not sure I fully understand the question. If you're asking, should government fund these projects, I think that's one way to do it. Certainly public-private partnerships have been done, on mitigation efforts across the country. That's something we're happy to have a discussion about in terms of funding, because obviously these projects need funding. Coming back to the surcharge point of it, as I stated, that is an additional cost that's not reflective of risk, right? That's an additional cost on a policy because of who the policyholder is or what line of business they're in, which, that's up to you all to decide on. But it's really not an insurance equation. So in terms of funding mitigation, funding resiliency, it's something the industry is eager to partner on and trying to get those answers. We're happy to have those conversations.
Yeah, thank you, Mr. Chair.
Thank you, Eric.
Senator, so following up on Sean and Ethan, specifically on the disclosures that we currently make, that was relevant to your question. The major one is through the NAIC, the National Association of Insurance Commissioners, annual climate risk disclosure. This is a risk management tool for state insurance regulators to request from insurers on an annual and non-confidential basis the disclosure of insurers' assessments and management of their climate-related risks. The purpose is to enhance transparency, identify good practices as well as vulnerabilities, provide a baseline supervisory tool to assess how climate-related risks may affect the industry, promote insurer strategic management, to encourage shared learning and continual improvement, as well as to align with international climate risk disclosure frameworks. It was amended several years ago, 2022, to expand to include the parameters of the Task Force for Climate-Related Financial Disclosures, or TCFD, and this incorporates international best practices in climate risk reporting. There are four basic tenets of the TCFD. They fall under governance, strategy, risk management, and metrics. It is through there and that much information can be found. Also, as I was thinking about your question, I would encourage you to talk to and work with the Department of Insurance, because Ethan, I believe, perhaps it was Sean, brought up that some information that might be disclosed might be of a proprietary nature. There's a lot of proprietary information that is shared between insurers and the Department of Insurance, because the Department of Insurance approves all of our rate requests, increases and decreases, and has to make sure that we are fully addressing all of the risks that we are taking on, so that we have sufficient capital to pay the claims that we have promised to pay. So I would encourage you to talk to the department, and they can provide information while maintaining the confidentiality of what needs to be confidential. I did want to focus a little on what the department and the legislature has done as leaders in this area. The department has issued Bulletin FS 44, which directs Connecticut insurers to take a strategic approach to managing climate risks that considers both current and future risks and identifies actions necessary to manage those risks in a manner proportionate to the nature, scale, and complexity of their business. The legislature in 2021 passed legislation that created a framework for the Department of Insurance's reporting to the legislature of the state's progress towards addressing climate-related risks, monitoring greenhouse gas levels, and bolstering resilience of insurers. The last piece I wanted to talk about was what I will say is a potential unintended consequence, that's the word I'm looking for, of a surcharge. So surcharges, as Sean pointed out, are meant to be pass-throughs, but it really depends on how another state would view a assessment fee or surcharge. Insurers and states operate under a retaliatory tax structure, and this is what that means. If a state has a aggregated tax burden that is less than another state's. And when I say aggregated, it's the premium tax, it's the surcharge, it's the fees, it's assessments, it's the aggregated amount. Then what they will not allow is an insurer from that higher tax state to come and sell products, sell policies in their state at that lower rate. They will charge the higher rate of your state. So what happens is, if Connecticut were to impose a surcharge, and if, say, Nebraska, Iowa, another state looks at that and says, we are going to consider that as part of your aggregated tax burden, just picking on two Hartford-based companies, when the Hartford and Travelers operates and sells in Nebraska, they are going to be paying in Nebraska that higher rate of Connecticut. So it's just something to keep in mind as you consider what I would say solutions, options, opportunities that you have before, because your goals are 100% correct. You want to improve resiliency, you want to improve mitigation efforts, we want to reduce our vulnerability to increase severity of storms, to increase frequency of storms, to increase flooding, increase damages and losses. We stand with you on that. It's how you get there. You, underneath the bill that was last year, are targeting a segment of the economic fabric and using insurance to get there. We object to just that method of going, but we don't object to the overall ends of improving resiliency and mitigation. So I wanted to say those words. Pete has some final comments, but you may have a question for me. I see it pregnant right there.
I couldn't possibly let you go.
Of course not.
Eric and I get to talk a lot, and we agree on a lot of things too. And I understand we talk about unintended consequences all the time. It seems like 50% of what we do in this committee is fix unintended consequences from other stuff we've done. So I 50, maybe more. So I do worry about things like that, but I also tell you all the time, it's like we want the industry to do more, so we can do less, because you don't want us making decisions on how you guys run your industry, because I will fully say you know it better than we do, and you know what the unintended consequences might be. But I'm going to use one little random factoid, and I hate doing this, but it happens. In California, they had a statistic, I think it's going back a couple of years, where they had over $500 million invested in fossil fuel companies. and almost no money, the insurance industries had almost no money invested in renewable industries. And it's like, you see something like that and you're like, yeah, I know freedom, as you mentioned, freedom to invest. But at the same time, you're investing in companies that end up costing you and the consumers more money and hurting policies. So that's where we feel like we need to step in and say, hey, you shouldn't do this. I want you to correct it before we have to correct it. And that's the goal I think we should all work together on.
I understand.
I'm sorry, that wasn't a question.
I understand your point. I said I can't. There's no question for me to answer, but I understand your point. I will say that if you look at the portfolios of many insurance companies, they are transitioning to more investment in renewable energy. And I'm not here to defend one industry over the other. I will say that when insurers make their investment decisions, it is based upon the fact that they must protect their capital, because if they do not protect their capital, they will not have the amount of money that is needed to pay the claims that will come due under the policies that they promise coverage on.
And I get that, but also investing in a company that's destroying your capital in a different way. But regardless, Representative Parker.
Thank you, Senator. And thanks all for what you're sharing. It's really helpful. To pick up on that line of conversation, do you think regulation aimed at that investment would be more tenable as opposed to a surcharge on actually the policies for those companies? If I go down the line of using the insurance industry for this other policy outcome, I could see that in the realm of the uh, policies themselves, that feels a little more resonant to me. But then on the other side, around restricting where those investments can happen, is that a way to do it that maybe doesn't get at the core ideological issue around your industry use for other purposes?
So if you're asking me, would I support a bill that limits our investment opportunities? The answer is no. I knew
Would
that
you be
everyone
more-
in this room is absolutely blown away that I just said that. That's also a question that I would like to have offline, because there are political implications of one state focusing in one area and another state focusing on another area, and then the industry, which is national, international in work, is caught in between. So that is unintended consequences. That's a conversation I would like to have with you beyond this hearing.
And then I appreciate that. Expect the answer, and just wanted to put that out into the conversation a little bit. I guess the other conversation, and I was kind of looking through the goals that you articulated earlier and the previous speaker did, there's a lot of alignment there. Shifting costs from after to before, maybe there's ways to sync up a bit. But in this idea of we need more resources to invest in all this mitigation, which will help you and your clients, your members, save money in the long term. What ideas are you bringing to the table about how we get those resources?
Where do you get the money? That's always the question, right? We're often the target because we're viewed as the deep pockets, rightly or wrongly. We're an easy target to latch on to and aim at. I would say that oftentimes that is an inappropriate way to look at it, but still the goals are understandable. And what I have always said, and it's relevant to this conversation, it's relevant to when public health programs are put into the insurance fund so that they are not a burden on the general fund. If the legislature and the governor's office, if government decides that an effort is worthy, I think that the fairest way to go about that is to utilize the general fund or a variation thereof, whether you use the credit card and bonding, but I don't believe in completely protected sources of income, because come times of financial woe, I have seen protected funds swept quite easily. There's no such thing as a truly protected fund. Everything is available when you are under an economic pressure. So if we're going to be, if the state is going to be intellectually honest with itself and say that this public policy deserves funding, then it should come from the general fund. It should be spread across the greatest amount of Connecticut impacted parties, the tax base. And I would believe that. And that is at your discretion. That is your decision to make. And those are the comments I have on that.
The last bit on that, Mr. Chair, if you don't mind, and that makes sense to me. And again, I don't expect you all to come here. It's our just job to figure that out. Where should the money come from? So your answer makes sense to me. I guess I'm curious, to the extent that your members are telling you, hey, let's pass policy that will help decrease all these losses so we're not paying so much in these millions and billions of dollars for all this damage that's happening. Are there proposals that you all are putting out there that are aimed at that, whether it's putting more investment through the general fund? I mean, some of the other ideas that are coming up, maybe I just don't know as much because I haven't studied the issue as much as Rick and others, but are there opportunities that we could do more to help your clients in the long run?
I mean, and honestly, your ability is limited to bring down all of the cost pressures that make up the insurance premium. You have some ability in terms of looking at litigation issues. You have some ability in terms of allowing for easier providing of information, going from the classic and very slow papered system to the more streamlined electronic system, which remarkably saves an amazing amount of money when it comes to just mail that is avoided. You don't have as much ability to put downward pressure on inflation. You don't have supply chain issues. These are issues that are just, one state can't just take that on. That you can deal with the edges and the margins. And I will tell you, as just person to person, even getting to those edges are fights, and they're very, very difficult. From the insurance industry's perspective, it almost becomes a situation where, what is the regulation, what is the law that we have to deal with? All of the work is done on the front end to try to avoid something that's problematic. But once it's there, we then live with it. And then it's incorporated into your metrics and how you just deal, all your processes and how you just deal with things. So I have gone to my members so many times to say, are there outdated regulations and laws and rules that would help you do your business, reduce the cost of insurance? And people are like, well, we've been dealing with this for 20, 25 years. We don't know any different now. So you're dealing with the margins, Representative. I know that's not a great answer, but
Appreciate the perspective.
yeah.
Thank you. Thanks, Mr. Chair.
Representative Dubitsky.
Thank you, Mr. Chairman, and thank you, Mr. George, for coming in. You said something that got me interested. You said that you agree with the goal, with several of the goals that the legislature may be advancing, one of which it sounded to me like you said one of our goals was to reduce the severity and number of storm events. So I'm wondering, is it the position of the insurance industry that there's something that the Connecticut legislature can do to reduce the number and severity of storm events?
Thank you. I must have misspoken, Representative Dubitsky. I don't believe that the legislature will be able to reduce the number or impact and frequency and severity of storm events. I was likely referring to mitigation efforts that, with the increase in severity and frequency of storm events, that would help reduce claims and loss. But no, I don't believe that you can stop a hurricane. I wish you could, but I don't think that you can.
All right, thank you. Thank you, Mr. Chairman.
Thank you for that clarification. I think we can move on.
Yeah. Thank you, Eric, and thank you for the clarification there. My name is Pete Myers. I'm the Senior Policy Director at the Connecticut Business and Industry Association, where we do represent the insurance industry as well as several thousand other member companies all across Connecticut, with 90% of our membership being small employers. Throughout the conversation today, I've been taking a couple notes, and I wanted to point out a couple of proposals that CBI has championed in the past and ones that we look forward to championing in the future to address resiliency. I know Representative Parker raised a couple of comments about that, and I wanted to highlight one that we did with Representative Steinberg in the Energy and Technology Committee 2 years ago, working with the Connecticut Green Bank to reduce the savings investment ratio on certain CPACE loans to improve resiliency projects for manufacturers and facilities in Connecticut. One of the biggest things we hear from our members, and we did this in a survey 2 years ago, is the reason businesses are not making resiliency efforts or renewable energy investments like solar or heat pumps around their facilities is access to capital. So we looked at that as the CPACE loan program as a way to reduce the cost there with doing low interest, long-term loans. And I think there's more we could look at there with reducing it even further on the savings investment ratio. And I would refer to my friends in the banking committee to take a deeper look at that about ways you could increase access to capital there. Another point I want to bring is at the banking committee last year, there was a proposal brought by the Bankers Association to create a disaster savings account where you could, it's functioning very similar to the first time home buyer savings account that I could talk to you for hours about. But that would be used to incentivize businesses and homeowners to put funds in this account, receive tax benefits for doing so, use those funds to then help pay for your deductible if there is storm damage due to disasters or climate-related events. Now, there could be ways to look at that account as ways to incentivize businesses to contribute to that account, receive tax benefits for doing so to make resiliency efforts to their facilities. That is something CBIA would support, and we would look forward to talking about in the future. Now, I do want to hit on a couple of points about the insurance surcharge, which is something CBI did oppose last year. And the main reason I want to just point that out is the direct cost this will have on small, medium, large businesses all through Connecticut. Even if it's focused on the fossil fuel industry, 12% of our economy is manufacturing, who are high electricity and gas users, who would see an increase in costs for their fuel, but also an increase in their electric costs at a time where we already have about 120% higher electric rates than the rest of the country, saying that obviously the business community of Connecticut would be very concerned about. I also want to just end with very quickly, to stay under my 5 minutes in total here. In our survey last year, 86% of business owners in Connecticut, small, medium, and large businesses, all said that they're seeing costs of operating their business increase in Connecticut. That is certainly something that I know the legislature takes very seriously, especially focused on those small businesses that are in every community across our state. Now, look, we are focused on ways we can reduce the cost for businesses by looking at the savings investment ratio program with CPACE loans and the disaster savings account and other ideas that we're always happy to talk about. But a surcharge would only increase those costs for businesses at a time where 86% are saying they are continuing to increase. So that's it for me. I hope I stayed under my time, but happy to take any questions.
You were fine. Any questions? No, not seeing any there. I want to thank you, gentlemen, for coming and testifying. Next speaker is Connor McDonald. Please feel free to introduce yourself and proceed.
Okay. My name is Connor McDonald. I'm an attorney with the Center for International Environmental Law. I work with the financial strategies team, and our work focuses on the legal obligations and liabilities of insurance, the pension industry, and other financial actors in relationship to climate work and climate risk. Climate change is real and it is here. We've already passed the 1.5-degree threshold set by the Paris Agreement. And as the planet warms, extreme weather events are becoming increasingly severe and intense, more frequent and more costly. Governments around the world and across the country are seeking practical tools to finance climate resilient infrastructure in response to dramatic increases in severe weather and the impacts they have on their communities. In July 2025, the International Court of Justice recognized that states have an obligation to mitigate climate risks and to finance climate adaptations. Connecticut itself, as we've recognized today, is exposed to extreme climate risks, including flooding and wildfire, and it will only increase as this crisis increases, and it continues to damage and destroy insured property and the well-being of Connecticut citizens. The insurance sector can play a positive role in addressing this climate emergency, and this bill provides for data disclosure that will help Connecticut citizens be better positioned in the event of future extreme weather events and for funding resiliency infrastructure. The fossil fuel sector, of course, is principally responsible for climate change, but the insurance industry plays a uniquely contradictory role in the climate emergency. The industry facilitates extreme weather through underwriting and investing in fossil fuel infrastructure, while simultaneously shifting the costs of mounting climate risks onto consumers by raising premiums, reducing coverage, and sometimes withdrawing entirely from a region. Despite heavy catastrophic losses, including the costliest wildfires on record, the U.S. property and casualty industry recorded its best mid-year underwriting gain in nearly 20 years. When insurers recover their escalating climate losses, homeowners, renters, and businesses are left bearing the costs. The parties responsible for extreme weather events, principally fossil fuel sector, should be held accountable for the risks that they create. It's worth noting that the insurance premiums across Connecticut were up 13.5% as of 2024, and that's from CT Insider. A quick note about the regulatory scheme and who gets to make decisions about insurance in our country. Under the McCarran-Ferguson Act passed by Congress in 1945, the Congress has fully delegated regulation of the insurance industry to the states. So in a way, the buck stops here with insurance regulation at the Connecticut legislature. We also can't rely on other states, larger states, to come up with solutions. The Commerce Clause and the Dormant Commerce Clause of the U.S. Constitution prevent regulations cross state boundaries and that of commerce, and that includes insurance. So in many ways, this legislature is the deciding body on insurance solutions in the state. The surcharge bill will fund climate resilient infrastructure and reduce the burden of extreme weather events borne by homeowners and municipalities in Connecticut and mitigate and lower future costs of insurance. The question is not if costs from extreme weather events are coming. The question is who will pay for them and will Connecticut be ready? This bill is a step towards ensuring that Connecticut residents are prepared for future extreme climate events. Thank you.
Well, thank you. I believe first up, Representative Callahan has a question.
Thank you, Senator Lopes. And again, I'd like to say I apologize for not being there in person. I have other meetings scheduled in my district. And I was especially upset because I thought I was the famous UFC fighter was going to be before me, but I got his name wrong. But sir, I wanted to ask you, you mentioned a couple times during your remarks that the fossil fuels are responsible for climate change. What percentage of climate change are fossil fuels responsible for?
Well, climate change is a result of increasing carbon emissions in the atmosphere. There is an extensive body of scientific attribution science that makes that connection clear. I think we can say, we can look to those reports, but the vast majority of the changes in the climate that we're experiencing are directly related to carbon emissions in the atmosphere.
So, but the vast majority isn't a percentage. So I guess I would leave that to ponder. But when it comes to the fossil fuel industry, we've got companies, we're downwind from approximately 14 states. So it seems like this meeting is going the route of let's start charging fossil fuel companies that serve our state with surcharges, and this has been done in New York and Vermont, and they're embroiled in federal lawsuits already. But it seems like that's something that you would endorse, that we begin to penalize or lay some blame financially to fossil fuel companies and have them pay for resiliency. Is my understanding correct?
I would not say that we were advocating penalizing or blaming fossil fuel companies. I think this is the cost of their business. This is one of the things that this is part of their business model in producing these chemicals. It's just a cost of their business. This is a risk that they're creating, and we're advocating a fair allocation of that risk to the parties that are primarily responsible.
Okay, I thought that's what I heard. Very good. I couldn't disagree more, but at least I know the direction. Thank you.
Thank you, Representative. Any further questions for Mr. McDonald? Not seeing any. Thank you very much for coming and testifying today.
Thank you all.
Next speaker is Carly Fabian. Oh,
Hi, I'm on Zoom if that's okay.
I
I'm
see you
just
now.
gonna-
That's fine. Sorry, I just was looking in the crowd for no reason. Please proceed.
Thank you. I'm just going to see if I can share my slides, if that's all right. Just might take me 1 second. All right. So hopefully everyone can see a slide that says ensuring resilience in Connecticut. Thank you so much for allowing me to speak today. My name is Carly Fabian, and I'm a senior policy advocate at the National Consumer Advocacy Group, Public Citizen. And I work specifically in the climate program where I specialize in insurance policy. And so I'm going to talk about some things that we have all agreed upon today. One of the things is that climate change is driving an affordability crisis. We did an analysis last year of how insurance premiums are going up across the country. This was a zip code level analysis based on new data, and we mapped it out on our website. I'd encourage everyone to go take a look at that. You can input your own zip code, your own community, and see how insurance premiums are rising. But there's a few key takeaways. One of them is that insurance costs are rising far faster than inflation, and they're going up the fastest in areas that are the most vulnerable to climate change. So what we're seeing is that people are paying for risks that they themselves did not generate or take on. They're paying for risks decided for them by companies who had early warning about the costs of climate change but did not act. And then the other key takeaway is that if you scroll it, you can see one state that really stands out in particular, and that's Connecticut. Connecticut is uniquely vulnerable, not just on the coast, but across the state. And so what we need now is a long-term plan for climate change to address the affordability concerns because everyone is going to suffer. We're going to see people who are at risk of losing their homes, where this is breaking their budget. Municipal governments are going to suffer. The tax base will suffer. And so Connecticut needs a long-term plan. And unfortunately, we haven't seen so far any long-term credible plan from the insurance industry. What we're seeing is an emphasis on using short-term, one-year contracts to drop people and just raising premiums in a way that over time is simply going to become unaffordable for everyday people. And this is where Connecticut can and should lead. We're talking to departments across the country, and some of them are really hoping that Connecticut will lead. There is not only a regional influence, but a national influence because of Connecticut's history as the headquarters of insurance. And the good news here is that we do already have the tools. Research from IDHS and others shows that there are practical, tangible, near-term steps that we can take, putting on new roofs, doing flood mitigation efforts, and hardening homes and businesses for wildfires. And so that brings us to the key question that we're talking about today, which is not how to do it, but how to pay for it, because we know that early money matters more. Every $1 spent on resilience saves $13 later on, according to the Chamber of Commerce and Allstate research. And so as we've been looking at programs across the country, we're looking at how they're funding them. And what we're seeing is clearly that when states adopt grant programs, there is very high demand. Homeowners want to take action, but they need the funds up front because it's often hard to justify that $15,000 if you don't have it, but you get the savings later on. And the best source of funding that we are seeing consistently is the insurance industry itself. States like Oklahoma and Alabama are looking to the insurance industry. And you can see this chart from Brookings that shows how often the insurance sector is the catalyst for this. And that makes a lot of sense because the insurance industry not only has some to lose, but they have a lot to gain when we can lower costs for everyone long term. But there's a key catch, which is in order for these programs to scale, we have to start reducing emissions urgently. If we don't do that, we won't be able to make these programs succeed. And even the best investments, the best engineering and science that we have applied to people's homes and new roofs is going to get washed away. And so this chart answers a question that I think was raised earlier about just how much is climate change contributing to this. And we have research showing that over 20 years, this is about $60 billion of climate attributable insurance losses. And that's about $30 billion annually. So that's going to wash out our best resilience investments. But I think that's why Connecticut has recognized that we need to pair resilience and mitigation together. We need to pair it together by doing it at the home level, but we also need to incentivize broader climate mitigation and study other innovative ways to do this. And that's where we can turn to the insurance industry again, because not only can the insurance industry be funding these home level mitigation efforts to save people energy costs, keep them warm, but also they can catalyze broader emissions reduction. And the insurance industry knows this. There are some companies that are already taking action. Lemonade, for example, doesn't invest at all in fossil fuels. Other companies are starting to walk away from new fossil fuel projects. But this is simply happening far too slowly. And so it's going to undermine these resilience investments. But Connecticut has the opportunity to essentially reward companies who are already doing this by lowering the cost that they pay for resilience and ask the companies that are accelerating fossil fuel development, locking us into new projects that we don't need, asking them to pay more. So the 5% surcharge that's been raised today basically follows a simple principle. You break it, you buy it. And that's something everyone can understand. If you continue to contribute to climate change, either as a fossil fuel company or as an insurance company, you should pay a little bit more. And so this is a modest way to make sure that these companies are paying more into resilience and reward those who are stepping away from fossil fuels. And just one last point, we get this question often. If this logic makes so much sense, why isn't the insurance industry acting on its own? Why aren't they doing this to reduce their own losses? And it basically comes down to a few things. One is a collective action problem. There are some companies moving, but not enough of them. So they need stronger incentives. Two, they're driven by short-term incentives, thinking about investment profits, one-year contracts, and a 3 to 5 year time horizon typically. That's not long enough to think proactively about climate change. But fundamentally, insurance companies just don't expect to pay the price themselves. They expect to be able to raise costs, drop the most vulnerable, and walk away. Connecticut doesn't have that luxury, and so the state needs to take on developing a long-term plan, getting this funding now, and incentivizing insurers to partner with the state on this. Thank you, and I'd be happy to take questions.
Thank you. Any questions, Representative Parker?
Thank you for what you shared. Tell us what's happening in, was it Alabama you referenced? I'm curious. I mean, you landed here on the 5%, which I know has been a specific policy idea suggested, but without beating that horse too much further, what else is happening that you see as encouraging?
Yeah, I would say so. Alabama really was early on this issue, thinking about how to fund grants for homeowners who want to take action, who want to protect their homes, because they were recognizing that there's a serious coastal resilience problem after a series of hurricanes. And so they really took the lead on giving these grants up front for fortified roofs. And that met demand from homeowners who wanted to take action, who wanted to be safer, but were having trouble coming up with that upfront money. And so that's been really important, catalyzing a movement across the country of state insurance departments who are thinking about how do we get money into the hands of homeowners now, train those contractors now, get roofs put on. But we can think about this for multiple different types of resilience, not just roofs, but also home hardening and flood mitigation as well. But what we're seeing as different states adopt those is the funding is crucial. It's important to make sure that it comes from that source of the industry funding so that everyone can benefit early on, and we're not dealing with, funds that are waiting to be appropriated, not waiting for the federal government. But also it's really important, we would say as well, to make sure that these reach the most vulnerable homeowners. So that can be done by making sure that there's enough funding allocated. If it costs $15,000 to put the new roof on, making sure that it's not capped at 10, making sure that additional funding is available for those who can't afford it, outreach through nonprofits and local networks to make sure that people are aware of these programs. So there are a lot of steps that states can take, but I would say what's been missing from Alabama's approach is that carbon emissions piece of it as well, because as powerful as these are in terms of scaling quickly, it's just not going to keep up if we have climate change leading to higher and higher insured losses. We're looking at $30 billion on average right now per year, but that's going to keep going up. And so we need to find a way to pair resilience with emissions reduction directly.
Right. Thanks for making that point. That resonated with me. Just briefly, do you know how Alabama paid for those grants?
It was through industry fees.
Okay. Thank you.
Representative Callahan.
Thanks, Senator. Thank you, Carly, for coming in. Couple questions. It's industry fees. So I'm hearing industry fees on fossil fuel. I'm hearing industry fees on insurance companies, uh, all which will drive up consumer costs. But now you're also saying that we have to mitigate the fossil fuel use in order to mitigate climate change. So if a small state like Connecticut were to eliminate, say, another 50% of our carbon use, would that mitigate climate change?
Reducing fossil fuel use does mitigate climate change, and that's what's going to bring costs down for people. That won't eliminate the need for resilience and action on resilience right now, but it's going to make it feasible and possible. We're still going to need to be looking at new roofs and flood mitigation, of course, because some amount of this is already locked in. But if we don't start to bring the curve down on fossil fuels and climate change, those roofs and that flood mitigation just isn't going to go far enough. And so I would say it is within the power of Connecticut and the legislature to affect emissions reduction. It's also within the power of insurance companies. And Connecticut is a great place to be thinking about it because this is the headquarters of the insurance industry. Some companies are taking the lead on this. Some companies are taking those initial steps, but Connecticut should reward that and encourage companies to go farther and bring the market up to the level of some of these companies that are leading and taking initial steps. I would also say that it's important from a solvency perspective. The California Department of Insurance did analysis that showed serious losses if insurance companies don't have a long-term plan to deal with transition risks. And these are losses rivaling the losses the state is dealing with on wildfires now. So there's also a long-term risk for the company's investments themselves, especially as a lot of companies are invested heavily in bonds, and municipal bonds are going to be affected by climate change if we're losing the tax base, especially in coastal areas.
Okay, in California and in Hawaii, those wildfires were not attributed to climate change at all. They were contributed to management and management along the power lines in Hawaii and mitigation preparedness in California. But if CO2 is 4 parts per million of our atmosphere and man-made contribution is estimated to be about 11%, I just don't know how that's going to do anything. But you're also suggesting that we companies and maybe states stop investing in fossil fuels, even if they're a better return than other investments, which I don't know how we can do if you've got an obligation to get a certain return. But this, I'm sure these things are going to come up in session, so I won't belabor the conversation now. But I just don't know. I don't see the logic on where you're going with it. But I appreciate you coming in.
I'd be happy to respond to each of those points in writing if there's time. There can even be a benefit to switching to renewable investments. There's analysis that shows that, and we'd be happy to provide that in writing, that some of the companies that are shifting away from coal investments are actually doing better for it. But the problem we're seeing is that there's a perverse incentives toward those short-term investment returns in fossil fuels, particularly after disasters. So that's where we need the legislature to step in and think long-term and think about not just the short-term benefits, but enormous long-term benefits for consumers, for the industry, and for the state and for local governments as well.
Sure. Shoot me an email with the information. Thank you.
Thank you.
If you could send that to me or the clerk, we'll disseminate it to the whole committee. Representative Baumgartner.
Yes, thank you so much, Mr. Chair, and thank you for your great presentation. You referenced the Alabama model, which is very interesting, obviously, in reaction to a really bad hurricane that obviously, when you combine wind and water, can be catastrophic for any community, and certainly was for Alabama. Certainly a state that's their politics are pretty different than ours, yet still very proactive in addressing a very localized issue in that case. And so my question is, we've talked a lot about the issue of tying emissions to the actual insurance policy, so to speak, and, um, identifying new revenue sources to pay for these mitigation efforts. But in the case of Alabama, if I'm not mistaken, they've actually sort of mandated these discounts, right? If there were demonstrated investments in, within the home. So as you mentioned with the roof, right, and some of the other floodproofing that happened, then the insurance companies would essentially be required to provide such a discount to the owner of that insurance policy, and therefore seeing a reduction in the amount that they would be paying in insurance premiums, which is really what we should be focusing on, right? That an investment in resilience can also result in greater affordability for families. And it's sort of a 1-2 punch in that we can do that while also make strides to become more sustainable, resilient, and reduce CO2 emissions. So can you speak to the mechanics of it and also the politics of it, how in a state like Alabama they were able to achieve this?
It's a great question. And I would say we strongly support discounts. I think they just shouldn't be used alone. They should be paired with grants. And the reason is that for a lot of families who need this, who are in the most vulnerable areas, we know that, low-income communities are disproportionately exposed to flood damage in particular. And many of the families who need this just don't have that money up front. And so the grant becomes essential and it helps the contractors get started. They know that there are going to be households signing up for this who will have the money and they can get started. That training is really helpful in catalyzing the program. But then the discount can be really helpful because not only are people seeing that new roof, but they're also seeing how it affects their insurance premium. So it's important to have the discount, to have it clearly disclosed with a strong requirement by the state of a minimum discount. But then for those who have the money to do this upfront, that discount can benefit them as well. So not everyone will be able to get a grant, but if you have the discount baked in, and that's a requirement for everyone in the state with a mandatory minimum, that's going to allow more people to justify that cost. And the reason that we don't recommend discounts alone is just that it can take a long time for the discount to allow people to make that money back. So for some people who have that money up front, it's great. But if people don't, the grant is really important. So we recommend doing them together. As far as Alabama, I think it really just comes down to a recognition of how serious the costs, the economic costs are of disasters, recognizing that it takes a proactive approach. And so I think Connecticut should absolutely take inspiration from that and say, we know that early money goes farther. We know that $1 now is going to save 13 later. We know that if we collect money from the insurance industry now, not only is it going to save consumers money, but it's going to save the insurance industry money as well. It's going to allow them to stay in the market long term. It's going to allow them to serve communities that they've been serving for decades, rather than relying on this reactive approach of simply planning to raise premiums indefinitely or pulling out of the most vulnerable communities.
Thank you so much for that answer. And thank you, Mr. Chair.
No problem. Any further questions? Seeing none, thank you very much for testifying.
Thank you.
We have Sharon Lewis.
Good morning. I think it's still morning. Well, first of all, thank you for this opportunity to speak today. This is a subject that is near and dear to me. I would also like to thank the organizers for convening this critical discussion on insurance and climate. I'm here, well, my name is Sharon Lewis, and I'm here as a Hartford resident, an environmental justice advocate, and an insurance and reinsurance professional. 2 years ago, I testified before a committee in Congress on this very issue, basically the intersection of insurance and climate risk, because what we are seeing now is not hypothetical. It is already reshaping our communities, our markets, and our lives. Environmental justice communities bear the brunt of industrial and fossil fuel pollution. These are neighborhoods where air, water, and land are contaminated by pollution. Diesel traffic is constant, and polluting facilities are concentrated where people live. The fossil fuel industry drives higher rates of adverse health conditions, such as asthma, cardiovascular diseases, heat stress, and other chronic health conditions that directly affect families' ability to survive and thrive. But as we also know, the fossil fuel industry contributes to global warming. So economically, these communities are also harmed by what pollution drives. Pollution drives disinvestment, it depresses property values, and limits small business opportunities. Families spend their scarce income on medical bills and energy costs instead of savings or wealth building. And even though these communities contribute the least to global warming, they are the first and hardest hit when disasters strike. Climate change is driving more extreme conditions, hotter summers, colder winters, more flooding. And I'm sure you understand that now flooding occurs regularly inland. In other words, one does not need to live on or near a body of water to experience a flood. These days, heavy rains can cause flooding. I have a personal story to tell about what happened to me, but I'll get into that a few minutes from now. Housing conditions make all these situations worse. Many residents live in poorly insulated homes with low R value for insulation. They live with leaking windows and doors, slab construction with inadequate thermal protection, and outdated furnaces and appliances. During extreme heat or cold, survival becomes a daily situation, daily calculation of what am I going to do? How am I going to do this? It's commonly assumed that unfair treatment occurs during underwriting or claims handling. But contrary to popular belief, that is not entirely true. Discrimination and inequity often occur before the application reaches the underwriter's desk, before a claims file is opened, because many residents, many consumers are not offered the appropriate coverage in the first place. And that leads to underinsurance, high deductibles, disappearing coverages over time. When a claim is eventually paid, it is often insufficient to cover claims that homeowners have, forcing them to either downsize or move because they can never recover what they've lost due to the lack of adequate insurance. The situation is very complex because when we talk about the construction of homes, we think of homeowners, but nobody thinks about the renters. In every major city in this state, at least 70% of the residents are renters who have no control over the dwelling that they live in, no control over the efficiency of the unit, no control over what type of furnace they have to heat their homes, no control over the windows, and all the other things that contribute to energy efficiency. This is very, very difficult for me because it's highly personal, but a lot of these folks who are renters are basically uninsured because most insurance companies think renters are high risk. You know, the urban areas are full of crime and therefore they don't want to pay when someone says, yeah, I did have 15 flat screens. Imagine the catastrophe in an urban area when the renters don't get reimbursed for what they've lost because they've not been insured. Most people are just one disaster away from financial ruin. I know this firsthand because it happened to me. I planned my life and I thought that at this age, I was lucky to have what I have and to go out gracefully. But unfortunately, on December 4th, 2022, as a result of a rainstorm, I had a flood in my basement. My basement filled with nearly 5 feet of sewage from the neighborhood. And it destroyed almost everything I had. Why? Because I was planning to move to Middletown. And the deal fell through because the new house was full of mold. So we brought the boxes back and put them in the basement. And my husband said, let's put them in the basement. I'll get you a pod. We'll put all the boxes in the pod and we'll move the pod to the new house. Well, the pod came on Friday, December 2nd. It rained on Saturday, December 3rd. And I woke up December 4th to the most horrific situation I've ever experienced in my life. In an instant, I lost everything. My whole life was in those boxes that I was about to move. So why am I so emotional about this? Because my insurance company denied my claim. They said I didn't have sewage backup coverage, which I thought I had. The combined sewer overflow valve that the water company installed in my basement 30 years ago failed. And that is why my basement filled with sewage from the neighborhood. My house was the only one known. Other people had the same situation, but they were ashamed to talk about it. This is not something you want known. The expense of cleaning out my basement and sanitizing my basement was life-changing for me. The flood overturned my oil tank, destroyed my furnace and hot water heater, and left my home uninhabitable. I told you before that State Farm denied my claim, and I was forced to live in a hotel for 7 months. And after the hotel, I had to move to an apartment temporarily. None of this was reimbursed by the insurance company. I'm still not in my house almost 3 years later. And so far, I've spent thousands of dollars just to survive this most catastrophic situation. This experience taught me firsthand that insurance coverage alone is not enough. Many families in environmental justice communities who face greater climate risks and live in substandard housing cannot absorb even a single event less than the one I experienced. I'm very concerned and pretty much put off by the fact that, as I mentioned, the discrimination and the bias begins before the files get to the underwriting desk. I'm put off by the fact that the insurance companies claim that they cannot release their underwriting data. They cannot release their claims data because it is proprietary. And I find that to be highly contradictory because I used to be an insurance professional, and insurance companies routinely claim that loss data, underwriting models, claims practices, and risk assessments are proprietary, but at the same time, it is the highest mobility, it has the highest workforce mobility that I've ever seen. In fact, moving around is considered a plus, not a negative. I say this to say that if it's so proprietary, why is it that the underwriters, the claims managers, the actuaries, the loss control folks, and marketing executives move freely from one insurance carrier to another, bringing with them that proprietary information from one insurance carrier to another? I digress a little bit, so I apologize for that, but
And Ms. Lewis, we do have to wrap up
okay.
by 11.
Thank you. This legislation addresses all the things I spoke about by imposing the 5% surcharge on the premiums for those insurance policies covering fossil fuel infrastructure. This is not punitive. It's not punishment. This is a mechanism to align responsibility with risk. Funds collected could be used to support climate resilience efforts, mitigation efforts, and recovery, helping communities that have been underinvested for decades. For example, the surcharge could fund resiliency hubs, community emergency planning, energy efficiency upgrades, flood protection infrastructure, and programs to ensure homes and businesses. These investments reduce the severity of losses when disasters strike, and they strengthen neighborhoods and give families and business owners a real chance to recover. I'm going to sum up now, but in short, insurance is not neutral. What gets insured gets built. What gets insured gets financed. And when harm follows, it is these overburdened communities that pay first. Thank you so much for listening to my testimony, and I hope you understand the critical nature of what is happening to all of us. Thank you.
Thank you. Any questions?
Just want to thank you for sharing your story. Thanks for being with us today.
Thank you. Thank you everyone for attended. Hearing's over, and I hope we can move forward from this with some positive information and action. Thank you.